Hello everyone, it's good to have you on board today. It's another time with Tutor Ayo, and in today's tutorial, we're going to be continuing with course ACC101. It's a course we started last week, and this week we should be concluding on the course. With this being said, let's go straight into it. Okay. So we have ACC. All right. ACC101. So just like the thumbnail says assets and liability. Talking about assets and liability. We'll be emphasizing on what it means by asset and what it means by liability. I think I need to adjust this a little bit. Okay. Yeah, I think it's better this way. So, what is an asset? When you hear of the word asset, what comes in mind? Assets, excuse me. All right. An asset can be defined as tangible, all right, or intangible resources that is owned by the accounting entity, all right, which is expected to generate future income, all right, future economic benefits. Are we together? So let's take that down. The key point here is that it is a tangible or intangible, all right, tangible or intangible resource, all right. Let's take that. That's the first point. Tangible or intangible resource that is owned, okay, owned by an accounting entity, probably a company, an organization, a business, an individual, all right, an accounting entity there's an owner, accounting entity, all right, it's owned by an accounting entity. It belongs to an accounting entity. It belongs to someone, all right. So and it is expected that this resource, whether tangible or intangible, is to generate what? Future economic benefits. It's expected to generate future economic, all right, it's expected to generate future economic, all right, benefits. So basically anything, all right, that generates, that appreciates, all right, like land, all right, it appreciates. Anything that you can get today and in the next few years it can generate the money using purchasing it and even more, all right. Just like some other persons might get a car, all right. In case of a car now, if you say a car, if you are using a car for a business, all right, you can consider it as an asset because you're using as commercial, you use to make more money. Anything that you buy to use in making more money, all right? I think I need to get rid of this. Is referred to as, okay, is referred to as assets, all right? But anything, on the other hand, that you buy and it takes money to maintain without generating income, without generating economical benefit, then that is liability. Now let's talk about liability. Liability, on the other hand, simply means according to what we have in the material, it says here that liability is defined as a legal obligation, all right, the legal obligation to transfer assets, all right, to transfer assets, all right, transfer assets, all right, or provide service to another entity, all right, provide service to another entity, all right, that arises from past transaction or events. Now, what are we talking about in essence? Liability, all right, like we have here, it says the transfer of assets, all right, to or provide service, all right. Now, when you transfer assets, all right, and somebody gets it, all right, and an entity definitely, if you are transferring the asset, you are transferring to someone definitely, all right, and somebody will in turn pay for that, all right. So at that point at which you are transferring, now whatever you are transferring to that person, all right, that makes the person pay for it, all right, whatever it is you are transferring to that person that is so valuable that it can create economic benefit for the person and for himself, for the person selling and for the person buying, person transferring and from the person receiving, all right. Now it can only be an asset, all right. That point at which you are transferring and is receiving, whether tangible or intangible, intangible in the sense that it could be service, all right. Goods are tangible, you can touch them, you can touch goods, but intangible like service, you can only feel them, all right. Probably you can see them like, oh, person's offering this service, or you cannot hold, can you hold teaching like this, all right. Somebody is offering a service, you cannot hold service. Services are intangible things, all right, so they are felt or they are seen, all right, unlike goods that you can see and touch them, all right. So that's why I said to be transfer of assets or provision of service to another entity, all right, that arises from past transactions or events. And basically, assets is that thing, all right, that takes, all right, money away from you, all right, takes money away from you. That is in layman's understanding. Something you have to buy or something you have to maintain with money, and it does not really generate money, all right. So now let's take this formula. It says here assets minus liability equals owner's capital, all right. So owner's capital equals assets minus liability. That's how you get your owner's capital. And to get assets, we have owner's capital plus liability. Owner's capital plus liability. With that, you can get assets. Are we on the same page? Now let's continue. So we have that as that. Now, permit me to raise the board so we can take something. Now let's talk about capital. All right. Now when we say capital, like we mentioned just now, capital is associated with items that appear in the assets of a financial position. Like we all know, capital is that resource you start a business with. All right. And it is associated with items that appear. All right, items that appear in the statement of financial position. All right, let me put that down. Capital associated with items all right, associated with items that appears in the statement all right, in the statement of financial position. All right, then we also have revenue. All right, it is also associated with items that appear in this associates itself with items that appear in the statement of profit and loss. We all know what revenue is. All right, revenue is the money you make, more of your profit. All right, money you make from transactions, revenue, and it's associated with items in the profits, all right, and loss, all right, associated with items in the statement, all right, in the statement or P and L, that's profit and loss. Okay, so we have that as that. Now we also have, it says that to allocate capital expenditure as revenue expenditure will cause profitability to fall, vice versa. All right, capital expenditure and revenue expenditure. Basically, these are expenditures you put in place to ensure that your capital functions properly And revenue expenditures are expenditures you put in place, expenditures you make that your revenue might scale. All right. And if you do any of these two at the same time, all right, profitability will fall definitely. You don't, all right, you don't do this at the same time. Either you are doing the capital expenditure or are doing the revenue expenditure. Because if you are doing the revenue expenditure, it sure definitely have an effect on your capital expenditure. So we have that as that. Now the point says here that revenue expenditure all right, revenue expenditure reduces profitability. All right, like I said earlier on, if you do both, it will definitely make your profitability to fall. All right, not if you do even one, it makes your profitability to fall. Not talk of now doing both. All right, so it's most is better. All right, just like we say, we use money to find money. All right, at most it's better you do one, then see the result, then you can do the other one. All right, at your own pace. All right. Now, in business activity, transaction is referred, all right, is referred to as the giving and taking of values. Giving and taking of values. All right, that's transaction. That's what it means. Okay. Now we have that as that. Now we have something called credit transaction. All right. When we say credit transaction, we are talking about transaction whereby payment is made or received time after delivery. All right. Payment is made. Transaction whereby payment is made all right, slash received or received after, all right, after received, sometime after received, sometime after delivery. All right, so we refer to that as credit transaction. Okay, now let's continue. So we have something called a cash transaction. Here, cash transaction means where goods and services are paid for in cash or by check when they are received on delivery. When they are received or delivered. Permit me to raise the board. Now, We have cash transaction. Cash transaction, let me see cash transaction, what do we talk about? That will mean that this is a transaction whereby payment for goods and services is made by cash or check when delivered. Payment, all right, is made by cash or check when received. Okay, so we have that as that. We also have something called cash discount. All right, cash discount. All right, when we say cash discount, what are we talking about? Cash discount is the reduction all right, reduction in the amount a customer is expected to pay. A customer is expected to pay. So we have that as that. Now there's something called invoice. When we say the invoice, what do we mean? Now the invoice, all right, is the purpose of the invoice, all right, is primarily to inform, all right, the buyer how much is owed for the goods supplied by the seller. It is not demand for payment. All right, that's the purpose. Like these days, invoice is used basically, all right, for demand for payment, or probably when you've made payment, you're given an invoice. The purpose has been used, has been turned into something else anyway. But originally, invoice, right, is just informed, right? These are the list of things you have purchased and the amount and everything, just to inform. All right, so let's get that straight. Invoice not a demand for payment. So permit me to use abbreviated word, not a demand, not a D for payment. All right, but it is a primary purpose is to inform the buyer how much owed. All right, it's just to inform the buyer how much owed. Okay, so we have that as that, and there's something, all right, there's an acronym which is, you might have seen it probably on the back of your merchandise, or maybe a good that you bought or something, or a product. It is, all right, an acronym for we call value added tax. I think it has been increased to 75% now. Sorry, 7.5%. It used to be 5%, but I think just recently, I think around last year, we increased to 7.5. I think during the administration of Buhari and Usibajo, his vice, it was increased to 7.5%. That's the value added tax. As a tax on commercials, merchandise and products we consume, right? As a value paid to the government. So we have that as that. Now, we also have what is called debit notes. All right, debit notes. The debit note is sent by the seller, all right, if the buyer has been undercharged on the invoice, all right. In the case of undercharge, if a buyer buys a thing worth of 20,000 naira and he was mistakenly, all right, charged 19,500 or 18,700 naira, all right. In this case, a debit note is sent by the seller to the buyer just to let the buyer know that your invoice has an error of undercharge. All right, so debit notes, as we have it, is sent in the case of undercharge. In the case of undercharge, a debit, all right, a debit note undercharge on the invoice, all right, the seller sends a debit note to the buyer, all right, to the buyer in case or in cases of undercharge, all right. So that is being handled. So let's take the last set of points for calling the wrap for today. Permit me to raise the board. Now we have something called, just like we have the debit note, we also have the credit notes, all right. And the credit note is all about, it's just the opposite of the debit note, all right. A credit note is sent by the seller to a buyer for a number of reasons. One, the buyer has returned goods because they were not ordered, or they were the wrong type, or quantity or quality, or a defect, or the seller has overcharged the buyer. Now, in the case of the debit note, we said it is the case of, in a situation whereby buyer is undercharged. All right. But in the case of the credit note, it could be for a couple of reasons, not just overcharging. All right. It could be the case of there is a defect in the product. All right. Probably the quantity or the quality. All right. And maybe I ordered for 20 things, I was given 50 things. All right. Or it was not in the intention of the buyer to request for the product. Now let's just quickly take that down. Credit notes. All right. So one, we have wrong type. All right. Maybe the products were the wrong type. In case of defects, all right, either in quantity, all right, or quality, all right, and it could be a case of overcharge. Could be a case of overcharge. So we have that and that. So on this note, we'll call it a wrap for today, and in our next class we'll continue from where we stop. Our next class we should be concluding on the course, as so that next week we can start with something different entirely. All right. So permit me to quickly highlight so I can know where to start next class. So thank you very much, everyone. I believe we've been able to get a thing or two into this class. As well to send a note to our private class, take a picture of the note and send it to your private class. Just use your smartphone, take a picture of the note you've taken, and do it, send it to your private class. Thank you very much, everyone, and I look forward to seeing you on subsequent tutorials. Bye bye.